Welcome to The Explainer from Talk Tickers. Today, we're digging into Rockwell Automation's latest earnings report, and man, is it a head-scratcher. This is a classic case of a company putting up great numbers, only to see its stock get totally hammered. So let's break down exactly what happened here.
All right, so let's get right into it. I mean, on the surface, this thing looked absolutely fantastic. Rockwell posted this huge earnings beat, but the market? Yeah, it basically took one look and just hit the eject button. The real question is, what on earth did investors see that made them run for the hills?
And this right here, this is the heart of the mystery we're solving today. You've got these stellar results on one side, and then this really sharp negative reaction from investors on the other. It really all boils down to that age-old Wall Street saying, right? What you did is nice, but what you're going to do, that's everything. Okay, so before we get to the bad stuff, let's start with the good news. And honestly, you've got to give them credit. Rockwell's performance in Q1 was, without a doubt, really strong. The numbers they put up were impressive no matter how you slice it.
So first up, let's talk about adjusted earnings per share. They came in at $2.75. Now, to put that in perspective, Wall Street was expecting something like $2.46. So yeah, they didn't just beat it, they absolutely crushed it.
And get this, it wasn't just about beating the estimate. That 275 number, that was a whopping 49% jump compared to the same time last year. I mean, that is some serious, explosive growth. The kind of thing that usually gets investors really excited.
The good news just keeps coming. Revenue was solid too. They brought in $2.11 billion, which was about $30 million more than expected. And that's a healthy 12% jump from a year ago. So, demand is looking pretty good.
And this number here, this is where you can really see their efficiency at play. This is what we call operational leverage. It basically means that as their sales climb, their profits climb even faster. Their operating margin expanded all the way to 20.7%, a huge leap from last year. It just goes to show they are running a really tight ship.
Okay, so you're looking at all these great numbers, right? Strong earnings, solid revenue, great margins. So why in the world did the stock tank? Well, the answer isn't in what they just reported, it's in what they said is coming next. Let's dig into the guidance, because this, my friends, is where the whole story takes a nosedive.
And boom, here's the smoking gun. See, Rockwell technically raised the low end of their guidance for the year, but, and this is a big but, the new midpoint of that range, 1180, was still shy of what the street was looking for. Analysts were really hoping for something north of $12. And when you're a stock that's trading at a premium, even a tiny miss on what's to come, that's a huge red flag.
Of course, analysts are quick on the draw. They immediately did the math and realized, wait a minute, if Q1 was so good, but the full-year number is just meh, that must mean the rest of the year is going to be a lot weaker. The market read that as a major warning sign. It basically screamed peak earnings, that the best was already behind them.
And if the numbers weren't enough, the tone from management on the earnings call just poured fuel on the fire. They kept using words like fluid to describe the economy. They mentioned that their customers were holding off on big investments. They talked about uncertainty. It wasn't the confident, bullish tone investors wanted to hear. It sounded worried.
So there you have it. You combine a guidance number that's just a little bit weak with a management team that sounds pretty cautious, and that's the perfect recipe for a sell-off. The past looked great, but the future? Suddenly it looked really cloudy.
And boy, did the market react. Look at this. Trading volume went through the roof. It was more than triple the average day. This tells you it wasn't just a few people getting nervous and selling. No, this was a full-on stampede for the exits. Big money was heading out the door, and fast.
And you have to remember the context here. It's so important. The stock was flying high, trading right near its 52-week peak. In Wall Street speak, it was priced for perfection. That means investors were expecting nothing but amazing news. So the second that slightly cautious guidance hit the wire, poof, that premium valuation just vanished into thin air. So this is really the key takeaway from all of this. When a stock is already expensive and the broader economy is a bit shaky, a great quarter just isn't enough. It's all about what's coming next. The market is always looking ahead, and in this case, it just did not like the view.
So, after all that, what's the verdict on Rockwell Automation? Is this big drop a golden buying opportunity, or is it a sign of more trouble ahead? All right, let's get into our Take the Next Call.
We're kicking off our coverage of Rockwell with a market perform rating. Look, this is a fantastic company, one of the best at what they do. But with the headwinds they're facing, the stock just isn't a screaming buy right here, right now.
Okay, so here's how we're thinking about it. The bull case is pretty simple, right? These guys are amazing operators. They execute like clockwork. But the bear case is that whole murky economic picture we talked about, and we think that's going to put a ceiling on the stock for a little while. So our prediction? The stock is probably going to be stuck in a range, trading mostly sideways. And that leads to our trade idea. You could consider selling covered calls. It's a strategy that can let you generate some income from your shares while you wait for the bigger picture to clear up. Kind of like getting paid to wait.
This is not financial advice.